Hi everybody, I'm Steve McDonald. I'm one of the editors at Investors Daily Edge, and this is your midweek market update. In focus today, property of all types rebound. Mark Mobius talks about the emerging markets. The uninformed are arguing for a trade war. Gold fever is about to explode. The unemployment numbers are coming again Friday, unfortunately. And of course, the slap in the face award. Well, home prices were up again last month, both commercial, that includes hotel and leisure properties, and were either firming or moving up. There have been large price increases in major metropolitan areas, and every home builder is seeing some sunlight. Since I can't believe even Obama is crazy enough to raise taxes, even on his favorite victims, the so-called wealthy of this nation, I have to believe we're at a real turning point here in real estate. People in the business world, whose opinions I trust, say we could be back to pre-crash highs by 2014. Now that may be optimistic, but it's really nice, isn't it, to hear something positive from the talking heads about property. Mark Mobius. For those of you who don't know the name, he was probably the first real China maven before anybody knew where China was. He is a quintessential international marketing guru. He had some nice things to say about the future of China, which isn't really news, but what he had to say about Turkey and other emerging markets was news. He really likes Turkey, that's the country. He talked about their strong currency, their reserves, and their banking sector. He also alluded to the fact that there are pipelines coming from the east that will meet in Turkey that will have a huge impact on their revenues. He didn't go into much detail about it, but it sounded like one of those ideas that we should take a closer look at. He was also hot for Brazil, Russia, South Africa, and Peru. This guy is not to be ignored. Next up, free trade. This is a surprise. 53% of the people surveyed in this country said they thought free trade was hurting us here at home. The pressure of the recession is beginning to create some very crazy thinking, and this is crazy. The only growth we see in American companies right now is in their international segments. If we get an out-of-control anti-trade sentiment in the U.S., we could be in real trouble. Like it or not, we're in a world market, and we can't just pull in our head and pretend it isn't there. The one big advantage we have had since the market and the economic collapse here at home, compared to the Great Depression, is that we did not have a trade war as they did in the 30s. That crushed them. This shift to blaming our trading partners for our problems is a very scary one and can only hurt us. Keep your eye on this one. It may be one of the best red flags for future problems with growth, or a complete shutdown if it really gets out of hand. Gold fever is coming. The increase in gold prices for the past 8 years has been impressive, but it hasn't yet entered what I call the stupid phase. The price increases have been steady and solid, and for the most part based on good decision making, but that's about to change, as it always does. Recently, I heard gold analysts calling for $2,000 and as much as $5,000 gold. As we approach the $1,400 level, the average person, who is usually completely uninformed, could start driving this into the stratosphere. Gold is a fear-based investment, and there is plenty of fear to go around. Once the uninformed start reacting to the higher prices and believing the forecast of big upward moves, there will be virtually no way to stop it. Nothing drives the buy-in of an uninformed investor more than fear and high prices. We could very well see another run similar to what we had in the 70s and 80s, but the top will be very short-lived, and it will tumble quickly, so make sure you have your trailing stops in place. Now, I don't know if I'd be a buyer here if I already had a position in place. If you haven't moved anything to gold yet, you're in a very tough spot. Buying here could be a very good but also very bad position. It's kind of a 50-50 call now. But whatever you do, keep your trailing stops tight and move them up as the price runs. Unemployment numbers. The unemployment numbers come out Friday, and they will, of course, be key to the direction of the market. Nobody expects any significant improvement, so any move down in numbers could be a big positive for the markets. Unfortunately, the rest is true. A bad report or increasing unemployment will be seen as a very, very big negative. More so than it should be. The market is primed in that direction. The best advice I have is to sit tight. Don't overreact to the news in either direction. We will not see any real changes in unemployment until there is some confidence in this government, and I don't see that changing until after the election. And finally, ta-da, the slap in the face award. It goes out to that great unknown who publishes all the garbage we get on internet news. This week, it goes to whoever wrote and produced the segment from last week on Yahoo News that called the upcoming tax increases, if the Bush tax cuts aren't extended, they called them the Bush tax increases. Here was their reasoning. Since Bush put the tax cuts in place, when they expire, they should be the Bush tax increases. Oh boy, do I have to say anything more about this? It's one thing for the Obama administration to blame all their woes on Bush, but this one is really out there. Is Obama held responsible for anything by the press and the media? I emailed the address that was listed for the feedback and asked if the author was on loan from the White House. I didn't get a response. That's about it. Thanks so much for being a part of this. We will see you Friday in the market wrap-up.